and welcome to the latest episode of Thinking Solo. I am your host and creator, Ryan Derousseau. I'm a fee-only financial advisor, and you can find more about me and my services at thinkingcapfinancial.com. I am not in my regular location today. I'm in the much more professional and more boring location of the office, and that's because I'm in the midst of tax season. And when I'm doing taxes, I'm often in the office where more secure and all that sort of stuff. But it got me thinking, and it's really related to today's episode, where we're going to dig into three specific things that are common mistakes that I see for the self-employed when it comes to their tax returns. And between my experience with doing taxes, as well as experience in talking with other solopreneurs, these are the three things that really popped out. And it kind of stands to like a point of emphasis because, last week I published a conversation with writer Elaine Pofelt, and she has experience covering solopreneurs and small business owners for many, many years, and she's also been one herself for many, many years. And in that conversation, she basically mentioned that when you go on your own, you essentially have to become a tax expert to succeed in business. And, it's in some ways very true because you need to understand sort of the implications of certain decisions and whatnot. It doesn't mean you have to sit there and do your taxes yourself or anything like that, but you need to understand what's going to go into the tax return and how that's going to impact you, because whatever you flow from the business then flows to you. Even if you are a C Corp or something like that, it's still going to be flowing to you in some way. And so we need to sort of figure out the best way to do it. And if you're not prepared, you can leave yourself in a really tight spot, which can take a really good business idea or plan and derail it right away, because you could have growing profits and growing revenues and all that sort of stuff, but as soon as you have a huge tax bill, that could all be wiped away. It could create fear. It creates the inability to invest in the business, and now we have to go back in-house somewhere just so we can protect ourselves from the big tax bill that we had. And so really, when we're talking about becoming a tax expert, it's more about sort of protecting yourself from that potential and that reality. So shortly, I'm going to go through three things to think about as you're doing your taxes this year and ongoing. So we're going to go through that. We're going to go through the three things that you need to do and recognize from a tax standpoint as a business owner. And then at the end of the episode, I'll have another movie recommendation for you. So let's go. All right. The three mistakes self-employed make on their taxes. I'm going to start with the first one that is the most common and probably one that you may even have experienced, and that's in not adjusting estimates throughout the course of the year. This can have dramatic impact whether you're growing or not. So in the early years, as you begin building your business, you're going to have either small revenues or medium-sized revenues, but at some point they're going to really start to jump. And there are ways to avoid penalties from that jump. But if you're not properly estimating taxes from that jump, you could find yourself with a big tax bill come March or April, depending on when you're filing. And the only way to protect against that is to plan throughout the year to ensure that you're not to ensure that you are saving enough to cover the tax bill come tax time. And the best way to do that is actually checking in and creating estimates based on where the revenues and the income are today, as opposed to where you kind of expected them back in March or April when you were doing the taxes. And so estimating throughout the course of the year will help you pinpoint a much closer number, so you are either saving or paying those estimated taxes throughout. And then when you have reached a size where you have done a lot of growing and you're not seeing the massive year-by-year growth rates that you may have seen at the beginning, it doesn't mean you shouldn't continue to do the estimates in a way, because one, revenues could drop a little bit, or if they rise a little bit, they may have a dramatic impact on the bottom line. And so checking in on a regular basis will ensure that you have the proper estimate and that you have more money that can be reinvested in the business or just sent home. And so knowing that dynamic is going to really help you know what you can invest in the business and where what you have available to invest in another potential growth opportunity as you are trying to turn the business from something of a plateau into either a growth engine again or another line of business or something like that. But you're not going to know if you're constantly worried about that tax bill. And even if you're not worried about it and revenues are starting to falter a little bit, and that's why you're worried, well, maybe it's time to go back to the estimates as well, because maybe that'll free up some cash to help you keep you in a secure spot while you're trying to get over whatever you're trying to manage within the business. The second thing that I often see, and I've talked about this before, but it's either opting into the S Corp too early or too late. It happens too early when you immediately want to get into an S Corp and there's really no real reason to, because you have to basically pay yourself a salary that's reasonable for your profession. And if you are not making profits that are reasonable, you're just basically increasing the amount of oversight and the amount to file your taxes by opting into the S Corp, and we don't want that. But also, on the other hand, we don't want it too late. I've seen partnerships where, they have $700,000, $800,000 in profits, not just revenues, but profits, and it's all going to the owners directly, and there's no S Corp protection, and so therefore, instead of paying, Social Security and Medicare taxes on what their salary would be, they're paying it on the full amount, so they're reaching the Social Security max, but then the Medicare tax is also building through for 180,000 beyond, and so it's really dramatically increasing the tax implications for them. And by waiting too late, they could have been saving potentially for years in some cases, and without sort of accounting for that, it's hundreds of thousands of lost revenues and dollars and profits, however you sort of want to describe it, because they hadn't picked the right structure at the right moment for their business. So you don't want to start too early when it comes to the S Corp, but you also don't want to start too late, because if we start too late, then it's really easy to show the damage after the fact. Too early, it's just you're adding too much to your plate for no real reason. The third reason that I see, or the third thing to think about, is not accounting for past losses or carryovers, which can happen in years prior to your gains or during years of gains. And this is honestly for both personal and business accounts. But if you have a business that's been building, but you have some losses mixed in there and you are not accounting for those year over year, let's say you do TurboTax and you've incorporated a loss previously, you kind of forgot about it, a few years go by, you still haven't accounted for it, it could be gone, and that loss kind of disappears. Well, that would be a shame, because that loss could have protected or cut against revenues and profits after once you start making an income again. And without sort of having that in place or being aware of that or paying careful attention to past tax returns, that carryover or loss would have disappeared. And we also see this in the personal returns, because if you have a capital gain or a capital distribution of some sort or a capital loss, I should say, and maybe one year you had a really, really bad loss, say $40,000 or something like that, and then next year you have some gains as well as some income, well, you could have been using that to cut some of the income and some of the gains, as many gains as possible, but also then potentially some income. But people forget about the losses because they, again, were filing themselves, or their accountant didn't look back far enough and didn't realize that there were these losses that could have been carried over through the years. And it's a real lost opportunity, because you really struggled in that year where there was a loss, especially when we're talking about business, it's a real good chance that you struggled in that year of a loss. And now that you're seeing gains, you should be able to kind of reap some of those rewards. But if you're not capturing and carrying over that loss, there's no way to do so. And so as you're sort of seeing profits for the first time, you're starting to feel a little bit of ease from the stress of just like getting by. And what could have helped is now taking those losses previous that where you really struggled and moving forward and give yourself even more breathing room, and they've disappeared. So you definitely don't want to do that. And I would strongly advise, if you know you have had losses in the past, to go back and review and see if you can bring them forward. And that's for both this tax year, but any tax year moving forward. The movie review this week is going to be for Do Not Expect Too Much from the End of the World. Now, this is not a movie that I can say, hey, go out and rent or see, because it's going to be a very personal sort of movie in terms of like whether you're going to actually get much out of it, because not everyone's going to be up for this type of cinema. But this is a Romanian movie from director Radu Jude that got a lot of attention last year in critical circles, and I only recently been able to catch up because I often am having to catch stuff on video on demand or on a service once it gets there, and I'm willing to pay a few dollars for it. But this is about a production assistant who's sent on a marathon journey to help film a work safety video from a very large corporation. So like this global firm has hired this production assistant's organization, and she's been sent out to get all this stuff in place. And while this is the task for the day, it's also very clear that this is the sort of what it looks like for her next day and the day after and the day after that. And I mean, it's probably an 18, 19-hour day when all is said and done. And she finds ways to, finds ways to entertain herself, finds ways to distract herself during that time, but it also speaks to sort of the modern world and the modern way of work. And so, again, if you don't like slow, gritty cinema, this is not going to be a rewarding experience or something you're going to have fun with or get much out of. But I do bring it up here because of the theme and the experience of the employee. As employers expect more and more, and they're paying less and less, or paying less and less, and paying less and less attention to, the impact on the worker. Really, it increases the emphasis for those willing to break free of that routine and go out on their own. And maybe this is not the best way for economies to function, but for an individual, I cannot think of a better way other than an inheritance or windfall to really escape this cycle. And it's either live at the behest of others or develop a business that can function with or without you, but always at your pace and within reason. Because if you're not controlling your schedule, then someone else is controlling it for you. And with the growth of AI and the reduction in salaries over the years, the impact on the workers is tougher and tougher and tougher. And so seeing that play out in cinematic form may or may not be everyone's, or be everyone's cup of tea or anything like that. And so I wouldn't say go out there and check it out. But if you do like that type of cinema, this is going to speak really, really close to the heart of why you probably went out on your own and what you were trying to escape. So it's well worth a watch in that case. That's today's episode. Again, you can find me on YouTube at Thinking Solo. I'm on LinkedIn under my name, Ryan Derousseau. Be sure to subscribe, comment, let me know how it's going, and I'll speak to you next time. In the meantime, keep grinding.